business. And before I turn it over to them, I want to thank Michelle Sanzone, who is one of our board members who supports Spencer as well. So with that, Rumbi and Alyssa, I'm going to turn it over to you. And when you're ready, I will pull up the slides as well.
I'll go first, Alyssa, since you'll start the presentation. Hi, everyone. So excited to see lots of people. As introduced by Ken, I'm Rumbi. I have been at AXA XL for 10 years this year, and it was actually my first job out of college. So I graduated in 2013 from Appalachian State in North Carolina. So go Mountaineers. I see Vance on here, so I have at least one other Mountaineer besides Alyssa. So really excited to be presenting today. I was always really interested in risk management as a student. I got my degree in risk management and insurance, and really happy that I got to have a career in risk management. So hopefully I can share some things, and if you guys have general questions outside of this, my LinkedIn will be attached. Alyssa's too. We're both happy to connect with you guys anytime. As far as my background as well, I'll mention that I'm from Zimbabwe. I was born and raised there. Came to the US for college, and I liked it enough to stay. So that's where I'm from, but I still have lots of family and connections in Zimbabwe. So likewise, if interested, let me know. And I'll hand over to Alyssa.
Thanks, Rumbi. Hey, everyone. Thanks so much for joining. So my name is Alyssa Nardi. I am an underwriter at AXA XL, and I graduated from Appalachian State University about 5 years ago with a degree in actuarial science. So I was planning to be an actuary, which is so math intensive in insurance. But then over the past 5 years, I've kind of tried out a couple different things in the insurance world. I've worked in risk management, I've worked in operations, and I did have some actuarial internships, but now finally I'm an underwriter in the professional liability space. And I'm just so happy. I'm really passionate about just the insurance field as like a career path. So yeah, I'm just excited to talk to you guys about me and Rumbi's jobs.
Excellent. Okay. Give me just 2 seconds. Make sure that the slides came up okay. Can you see okay?
Yep.
Yes.
Okay.
Yep, we can see.
Awesome.
Thanks so much.
You got it.
All right. So for this presentation, Rumbi and I are going to give you guys an introduction to risk management and how both underwriters and risk managers think about risk. So for our general agenda, first, Rumbi is going to give you guys an introduction to what even is risk management and just kind of an overview of that, because no matter what your job is in insurance, you're going to be thinking about risk management. And then after that, I will talk a little bit about my job as an underwriter and what do underwriters even do every day? How do we look at risk? And I'm also going to give you guys some examples. So I'll be talking about that. And then after that, Rumbi is going to talk about her role as a risk manager, and she'll also give you some really cool risk management examples. And then Rumbi will talk about some of the different types of risks for an insurance company. And then lastly, we'll just have a little Q&A, and we can just chat about all things insurance, risk, careers, anything like that. So as Ken said, like if anyone has any questions, just feel free to ask. Like, you know, we're keeping it chill. So that's the agenda. All right, so I want to start with just showing you guys how there is insurance for so many different things. Insurance really is so broad. It's more than just car insurance or insurance for your house. Basically, every type of company, they are exposed to different types of risks. And because of that, there are so many different types of insurance products, all different types of specialty products. So, and I feel really lucky because AXA XL, since we do property and casualty and specialty lines, we get to see all different unique types of risks. So, and I will mention that AXA XL, we are a commercial insurance company. So we do insurance specifically for companies, whereas personal insurance companies would do insurance for people, you know, like for your car insurance or things like that. So this chart here, it kind of just calls out a couple of the different types of insurance products that we have. And so because of this, like AXA XL is a huge company, the insurance market is huge, and it doesn't even matter your background. Like there's something that you could find interesting in the insurance industry. So first, for example, I'll call out fine art and specie insurance over on the right, fine art and jewelry insurance. So that specific type of product, we have a whole department of fine art experts, and they help museums and fine art collectors get insurance because art has very unique risks and it's very historical. So there's a whole department dedicated to that. And so that's just one of them. I used to work in that department actually. And I'll call out one other. So there is cyber risk exposure. So it's a huge up and coming area just with the forward movement of technology. So we have a whole department that offers cyber insurance, and that will cover any type of risk that could affect your company related to technology or the cyberspace. So you could think of like hacking or things like that. So there are huge exposures to companies, and there's a whole insurance part. There's a whole department, a bunch of underwriters, a bunch of risk managers, claims professionals. So I just wanted to highlight to you guys, insurance is really unique, really broad, and there are so many different types of products and different specialties.
Thanks, Alyssa. And with that as a background, I'll also start to talk about what is risk management. And it's important that we talked about all the products that are there because risk management applies to every and anything. Alyssa kind of said this as well. Risk management is kind of embedded in whatever function or role that you guys will choose to do if you hopefully come into the insurance industry. We hope everybody here does. Or some industry that is adjacent to insurance, you will be interacting with the risk management function. But even if you are not in the risk management function yourself, there will be touch points with risk management, or your role itself will have an element of risk management. So the first concept I wanted to talk about today was the idea of risk versus loss. Risk is the potential for loss to happen. And I've used this analogy of forward-looking and backward-looking. Loss is backward-looking. So I'll use an example on the slide of getting into a car to drive, assuming most of us have had the experience of either driving a car or being in a car, hopefully you're familiar. But the moment you step into the car and you start the engine, before you've driven off wherever you're going, there is a potential for loss. Accidents do happen. It is a part of life. So if you think about it in that way, starting your car and getting ready to go somewhere is the potential for a loss. Something could happen in the future. And then at the point that a loss happens, then it is now like you're now taking actions to address something that has happened in the past. So risk management is the process of anticipating and managing risks that are in the future, but also losses that you might face in the course of what you're doing. So managing risk is you putting actions in place. I've put some terms on there which you can read, but actions, controls, processes, strategies to address the risk that you have. And then in insurance, you also use this term called risk appetite. So oftentimes in risk, you're trying to think about how much risk you're willing to take when you do an action. So I'll use the car analogy again. When you get into your car, you'll put your seatbelt on. There's some people who are risk takers and they won't put on their seatbelt because they feel like their risk tolerance is high and they're okay driving without a seatbelt. But that's a form of risk management. Having insurance is a form of risk management. A lot of states mandate that you have insurance, but some people might not have it and may still drive on the road. But by having insurance, you're reducing how much risk you will have. And when an accident happens or when an incident happens, even though we don't hope it to, you are going to have mitigated your risk because the insurance company that you've been paying premiums to is going to pay for some of the loss instead of all of your loss if you didn't have it. Other examples are when you're driving, choosing not to look at your phone and text or Spotify or TikTok, like all of, which is distracted driving. We all do it, but by choosing not to do that, that's a form of managing risk. following road signs and so forth. So you guys get the idea of, we all are doing risk management when you get into our car and drive away. And then the other concept I wanted to talk about was the fact that risk management doesn't take away risks or losses. So just because you have insurance or just because you have been the best driver, it doesn't mean you won't be impacted by the loss. So you have to take risk in any activity that you take. Even going to college, is a risk. Anything can happen. You're choosing not to take money, I guess, to get paid and get a job by going to school, but you know that there's opportunity to come. And example of eliminating risk, I've said here, eliminating risk is usually too expensive to be practical. It would also eliminate potential profits. What I mean by that is, let's take the example of the car. You'd say, I never want to get into a car. The idea of like cars coming at me and an accident happening or something else happening, I don't even want to entertain it. So you eliminate the risk altogether by choosing not to get into your car. Well, then you'll take a bus, you'll take a bike, you'll walk, but you might lose the opportunity of working in another state that requires you to drive. Or when an opportunity comes and they say, hey, Rumbi, can you be in this place in 20 minutes? If you don't have a car, you've lost that opportunity. So an organization is always thinking about this push and pull of how much risk you're going to take and the potential for loss, and how much the idea of risk management is not to say we're going to have zero risks, but how much risk are we willing to take? So we can go to the next slide, Ken.
Actually, first quick question from
Yes.
folks. What are the top risks that keep AXA XL up at night from a enterprise risk management perspective?
Oh, I cannot speak for all of the companies, so I can, but I'll share some thoughts on what I've observed and what I see, even just from an industry perspective. Alyssa started talking about cyber risk. That is like one big one. We have quite a vast knowledge of cyber risk so far, but there will be so much more that is coming, so much more very smart and complicated types of risks that people are thinking up in their basements that we don't know about, that companies will be affected by. Artificial intelligence is going to impact that as well. So I'll say industry-wide, artificial intelligence is definitely a big one. Climate risk and, climate change, that is also a big factor that is impacting a lot of insurance companies and how we're going to handle it. And I talk about it a little bit later, but there are the physical risks of the climate changing. There are different locations and places where we have insurance. Like the big news, if you follow the news for insurance, if you're a geek like me, is that, some insurers are leaving Florida and California. They don't want to write, home insurance in those states because it is getting too expensive for them because of how much, wildfire exposure on the West Coast, flooding and water damage exposure in Florida and the East Coast. So I would say those are two big examples. There's also just the unknown unknowns, which we don't know, but off the top of my head, I'll give those as two major examples.
Excellent.
Mm-hmm.
Okay, off to the next one.
Yeah. So next I wanted to talk you guys through what's known as the risk life cycle, the risk cycle. Again, if you're ever in insurance or going to be in the industry, you'll come across this at some point if you haven't already in school. The idea here is to create a framework around which to think about risk management, the process and the steps to take when executing risk management. So I've given the example of getting into your car. I'll go bigger, and I've made up a potato chip company. We're manufacturing potato chips because I love potato chips. And I'm going to use that as an example of being a leader in a potato chip manufacturing company that also distributes the potato chips. When you come to think about what is risk management for a company like that, the first thing you're going to do is identify the risks. So as a risk manager, you'll walk around the factory and you'll see people in different steps of the potato chip production. I don't know enough about potato chip productions, but I'm making assumptions. There's somebody like chopping up, somebody managing different machinery. So I'm thinking about worker safety in terms of what gear they're wearing, what procedures and processes they are on the floor of the factory, how hot the oil is that the potato chips are going to be dumped into. All of these things are ways of identifying and thinking about risks. Let's say the product is made and it gets on a truck, and I have a truck driver who delivers it to different places all around the country. Process of identifying risk is thinking about all those steps. You often will do it brainstorming with other people in your team, and you'll come up with a list, which in insurance we'll sometimes call a risk register. That is all the risks that we can think of in our mind. Sometimes we'll get external help. Maybe we'll sit with brokers and think, hey, what else do you think we're exposed to? But these are all the risks that we have. That's the first and most important step. Then in assessing them, you're going to think about how to prioritize them. High, medium, low. These are the most dangerous. These are the most expensive. These are happening at a greater frequency. These are happening at a lesser frequency. For example, motor vehicle accidents is probably a high frequency, but in terms of the severity or how expensive a loss would be, is probably going to be much lower than if you had a really big accident in your factory and somebody was injured. So you're going to take the next step of assessing and thinking about all these risks that you've thought about with teams in your company and saying, how do we feel about them and which ones are most important to us, kind of rating them from highest to low. Then you're going to plan. You're going to say, okay, we are comfortable with some of these and we are less comfortable with some of these. And for the ones that we are comfortable with, how can we put a few more safeguards around them, but we generally are cool with them? Or for the ones that we aren't, how can we'll think about buying insurance. We'll think about bringing in training, a third party to come and train our employees to say, when you are near hot oil, do not drop something cold into it. Do not do this. So you might get steps together of thinking of who you can involve in the process to help mitigate the risk for you, in addition to having your broker work with you and buy you insurance is going to help mitigate the risk that you have. Then you take the risk. You go about the business, you do what you need to do, and you may take some mitigation actions and monitoring as you go. So as a risk manager, just because you've kind of set a plan, you can't go to Hawaii on vacation. You're still throughout the year sitting and thinking about, okay, how do I feel about the steps that I've put in place? How can I mitigate them? You've seen someone do something crazy on the floor. So now you think, okay, I need to do something. I need to put this in a manual. I need to talk to my insurer and make sure we have this kind of insurance. And then the last part is responding if there are any claims that you need to file or pay, whatever the case may be, depending on the type of company you are. But you also will be thinking about, okay, for the future, now that I've gone through kind of like a cycle of thinking about risk, what can I do to improve my processes? This is usually done on an annual basis for most companies. So at that point, maybe you're thinking, what other insurance can I buy? We've now added a new flavor to our potato chips. And this new flavor has, some aspect that we hadn't had before last year when we bought insurance. So now we're buying more insurance. So that is the risk cycle. I see some, I don't know if I have questions in the chat, but you'll let me know, Ken. I can't see the chat.
Yep, no, you're good so far.
Okay, sounds good. And then the last point I wanted to talk about before I hand it over to Alyssa again was this idea of 3 lines of defense model. Again, another schematic or picture you'll see, framework you'll see if you work in risk management. The idea here is that they are different groups of individuals in an organization who are helping to minimize risk for the organization at the end of the day. I like this example. This is not created by me, although I wish I had, but a colleague of mine created this to illustrate the idea of risk as being a cloud, a rainy cloud. And at the top, you can see there's no controls or mitigation in place. So this is, we have started operating and nothing is being done. Like there's just risk that exists. As I said earlier with the car, the moment you get into the car, any number of things can happen. That's the stage that you are. Then we start to think about the 3 lines of defense. The first line is the people who are usually responsible for managing the risk. In a company like AXA XL, we are an underwriting company. The first line of business are underwriters, Alyssa and her colleagues in underwriting, who are seeing the business coming to them. They are making decisions about whether they want to write a certain type of business or not. They are putting processes and controls in place based on what they see and what they understand about the risk. So the first line. So as it goes through the first line, you can see the size of the, I guess, the rain cloud, or the amount of rain coming down reduces. It comes to our team and risk management, where the second line of defense, risk management, internal control, compliance, all similar functions. What we do is we take what the underwriters have written. So we see what underwriters have done, and we say, do we think they have done enough? We also have the benefit as a function of seeing what all the underwriters across all the company is doing. So where, if you are an underwriter in property, oftentimes you're very focused on property risks and you understand property really, really well, but you might not see connections between property and what casualty is doing and what the cyber team is doing and so forth. So usually our functions are going to be looking at all of those underwriting teams, and then deciding, okay, where do we see some trends and how can we reduce risk further? And then lastly, internal audit is what's called the third line, and they do an audit of what the first and second lines are doing. They'll say, Rumbi, you said in your risk framework that you are going to take steps 1, 2, and 3. Give me evidence that you have taken steps 1, 2, and 3. And if I don't have evidence of number 3, then they'll say, okay, we're going to keep tracking and making sure that you are doing step number 3 as a way, again, to mitigate the risk, because that is a good form of risk management. After we've gone through these 3 lines, we still have some risk, which is residual, which remains, but not much we can do to control it. We might buy some additional insurance. We might take some additional steps, but in the end, whatever comes through is what will be the ultimate loss and impact to an organization. So happy to take any questions, but also happy for Alyssa to take over and talk about her line. Perfect. I have a question.
You do. Karan.
Hi there. So my name is Karan. I'm a risk management intern here in the Alexandria, call it DC area, with a company called Bonaventure. We're an alternative asset manager. Thank you for our speakers for being here today. I had a question about kind of possible impact and likelihood. So like, how can you measure the likelihood or analyze the likelihood of risk? Like, say there's obviously there's a certain factor of something bad happening. How can you measure the likelihood, or even just analyze the likelihood of something happening? Because it's anything can happen at any given time. So being prepared is obviously best.
Yeah, that's a good question. Oftentimes, the best tool that we have at our disposal is information. So you'll find most companies will use data of the past, of what's happened in the past. That's really common in like property risks or casualty risk at most lines. So if you have been operating in a line of business for a long period of time, you have underwriting information, so you know the profile of companies that you might tend to underwrite. You have claims information, you have industry trends. So most of the time we will look at likelihood based on those factors of what has happened in the past and how can we kind of predict what we think would happen in the future. So that's the first step you might take. We also have brokers who are great partners for us in insurance. Brokers work with tons of insurance companies, reinsurance companies, tons of clients. So they too have a vast amount of information that they can rely on to help us think about the likelihood of something happening. And then in some lines of business, you can use models, and that's where our very smart actuarial friends or friends who are at different modeling companies like RMS and so forth will, again, using data, using probability, using tools that they have, will come up with a model that will give you certain likelihoods, probabilities of things happening. Obviously, there's no way of knowing 100% that in 2023, we're not going to have any hurricanes or something. But I think, to my knowledge, I would say the best course or the best tool you have to think about likelihood is data and what you have experienced in the past.
Awesome. Thank you.
Mhm.
Yeah, great question and fantastic response.
Great. All right. So I'm going to go over this next slide, and I'm really just going to talk about my job as an underwriter at AXA XL, and I'll kind of just go over a day in the life, what I do every day. So I first want to start off by saying that in insurance, underwriters really are kind of the salespeople, you could say. We are working with the clients and the brokers and bringing in the business. So it's kind of like maybe a more math intensive risk management sales type of person. I really love it. So for long story short of what an underwriter does is an underwriter analyzes individual companies' risks and determines the amount, price, and conditions under which we would want to insure those individual companies. So I was able to kind of take the risk management cycle, and I'm going to go through it to try to show you what I do on an average day as an underwriter. So at the top, the first thing that I do is I assess these applicants, these companies that are applying for insurance. And I mean, it really depends what type of insurance company you are, but your applicants can be all different types of companies, from law firms to retail stores to real estate agents. It could be literally any type of company, and it depends what type of insurance you're offering. So yeah, we really just want to understand these companies. What exactly do they do? What risks are they exposed to? How many people do they have? What kind of revenues do they make? We just want to learn it all. And we're able to learn a lot of this information, for example, from talking to the clients, talking to the brokers, visiting the clients' websites, and reviewing applications. And this is a very generalized view of the underwriting process, but it really does depend on the type of insurance. But it always starts with just learning all about these companies. So then after we kind of understand these companies, we plan out their insurance coverage. What type of insurance coverage do they need? What kind of limits do they need? Like how much would be paid out in the event of a claim? What kind of wording do they need? Do they have any type of special operations going on? What premium do we want to charge? We have to plan all of that out. And it's kind of fun because it ends up kind of being like a puzzle. So that's where we plan the insurance coverage. After that, we do have to decide if we want to insure the client, insure the risk. And a lot of things come into play there. Usually for like company executives, AXA XL executives, they decide the risk appetite, as Rumbi mentioned, and they tell us how risky do we want to be with our clients? Do we want to charge certain premiums, things like that? And AXA XL is not the only insurance company, so there is competition, and sometimes we can't offer the best premium. So lots of different things could happen when we're figuring out if we're going to insure that risk. Next on the cycle here, I have mitigation advice. And I would say mitigation advice kind of is going on all the time. How can we lessen the risks and lessen the amount of loss that could happen to companies if bad things happen? So for example, I'll just think, if you think of a building and there's a risk of fire, mitigation for that risk would be installing sprinklers in the building so that if there is a fire, it can be blown out really fast. So it really depends what type of company. For example, I'm thinking about like a law firm. Really great mitigation advice would be, okay, make sure everyone in your office is qualified to be doing the work that they're doing. Do they have special designations, things like that? The next thing that goes on is we monitor at renewal. So for the most part, insurance policies are annual, so we renew them every year. So every year when that renewal date comes up, we basically do the whole process again. And we want to understand for these companies, how have they changed from the previous year? Are they growing? Are they expanding? Do they have new risks present? Things like that. So that's a very important part of the process. And then lastly, on this cycle, I do have respond to claims. And I mean, the whole purpose of insurance is so that if there is a claim, the insurance company will make the client whole again. So every insurance company is different, but here at AXA XL, we have a huge claims department of really qualified lawyers for the most part, and they are working with the clients when there is claims. Maybe they have to go into court. Maybe they have to figure out, like, they have to review our policies. Is that claim even covered? So that is kind of the last step in the underwriting process. And then it just goes right back to assessing more applicants and assessing more renewals. So this is really what I do every day. I go through this cycle, and it's pretty fun because I get to see all different types of companies, and I get to learn so much every day. So that is what the day in the life of an underwriter looks like.
Awesome. So I have a two-part question that came up. I'm going to attempt to frame both. The first one was, do your insurance policies cover more than just MPL in a single type of policy? And then the second one is, if it does, how do you underwrite to the different exposures between cyber and MPL and things like that?
Yeah, that's a good question. So my specialty in insurance is professional liability, and that means errors and omissions insurance, which covers companies for any errors or mistakes that they make, which could cause them to be sued. So we see all different types of companies. For example, there are architects, engineers, law firms, real estate agents, and there's risks that they can be sued and they make mistakes. You know, everyone makes mistakes. So what in my department, our risk appetite is just for covering the professional liability. And as you mentioned, sometimes, I mean, it really depends on the size of the company. We here at AXA XL, we mainly do insurance for really large companies. So their professional liability exposure is very large. So we just want one policy for that, focus on that. It's very complex. But there are some situations where underwriters can combine a lot of different types of insurance coverages. For example, cyber risk, professional liability risk, property risk. There's ways to package them. I don't work on that, but they are pretty common in the insurance marketplace. So I do see that a lot, but I don't work on that specifically. I'm all in on professional liability.
Love it.
Okay, so here is like the fun part, I think. So as I had mentioned before, I'm an underwriter in professional liability. So covering professionals for mistakes they make that could cause them monetary harm or getting sued. So one of the types of industries that I focus on is musicians' errors and omissions insurance. So if you think like every famous musician or singer that you could think of, they can make mistakes. Everyone makes mistakes in their businesses, but mistakes at companies can cause big losses, and that's why companies or musicians will get insurance in case these bad things happen. And specifically for musicians, the big risks to them in their business is someone says that they stole someone else's music or beats. You might see in the news, it's like, oh, that singer stole that person's song, and now they're taking all the money and they're not sharing the money, all things like that. That insurance covers that. And that's like really the main thing that musicians' errors and omissions insurance covers. But we also cover a couple other things. For example, breach of contract. There's a risk that if there are co-producers involved in songs that the contracts, no one's getting paid the right amounts, things like that, people get sued. So it's pretty interesting. I will say a lot of the time, there's a lot of ways to prevent the risky parts of this, which I will go through in an example. So to start, we assess our applicants being musicians. Oh, I see a question. Do you have a question?
I wouldn't say it's. I just wanted to ask, are there any crazy experiences that you're able to share of, example, like a musician stealing somebody else's music, or anything that you're able to share?
That's a really great question. That's the cool part. I can't share who our clients are, but literally every musician has this type of insurance, and there are a lot of crazy situations that I see where musicians get sued by kind of random people, and they're like, they stole my song, and it's like, okay, and it's always just like a random crazy person, like, so that's kind of not a big deal, but there are real situations that happen when the musician doesn't, that it's not their original beat. So sorry, I can't share specifics. So yeah, so as I said, we assess these musicians and we want to understand everything about them. How many songs do they have? Do they write a lot of music? Do they work with co-producers? Do they work with a music label? Do they have special musicologists reviewing their songs before they're released? We want to understand it all. And we learn a lot about that just through the applications and just learning all about the clients. So then we plan their insurance coverage. And there are situations when there's a lot of musicians that make public appearances, they can do speaking events. There's a lot of little side things related to their music that we need to understand and see if we can actually cover. So in the planning insurance coverage, we plan their limits, we plan their premiums, all things like that. We plan their policies, how do we define a loss, things like that. Then we have to decide if we want to insure them. Really famous musicians might be a little riskier because they just have more they're more out there, they have more exposure, so more people have heard their songs. And then next, we do offer a lot of mitigation advice. So as I said, it's really important for musicians to have their music reviewed before it's released. And there are people in the music industry that are just pros in music, and they're called musicologists, and they are able to review music to see if the beat is stolen. And so we make sure that our clients do that. We make sure our clients have written out and signed contracts related to royalties. So it's little things like that that are really, really important, and that could greatly mitigate the risk. As always, we monitor these renewals every year to see what has changed. Have there been claims? Is the musician going on tour? That's another big thing. And then lastly, we do respond to claims, as always. And like I said, in these situations, a lot of it has to do with music stealing, I would say. So it's so much fun. And every day we're just assessing these applicants. It's always fun to see really famous musicians. So that's an example of what I do specifically.
Excellent. Hot area and fun area to be involved with. So you're lucky.
And I'll add a note before I talk about my side of things. I'll say that if you guys are considering a career in insurance, it is really cool. I've met, in every area that I have colleagues, whether it's aerospace, marine, Alyssa doing musicians, E&O, colleagues underwriting fine art and specie, colleagues doing cyber. If you have a specific area of interest or something that is really interesting to you, insurance is a great career because you can actually be involved in that process. So some of our aviation underwriters are pilots themselves, or, we have a claims manager who used to fly commercial planes for years. and then he decided he wanted to come into the insurance industry, or fine art and specie underwriters who were art students. They worked in museums, and so now, because they have the the practical experience of having worked in those spaces, are really interested in that. So just a plug for insurance as a career, since we are on a Spencer Educational Foundation call, to say there's so many opportunities and cool things that you guys can do if you're interested. And I'll say as a tip, if you see someone who has a dream job of yours on LinkedIn, maybe they're underwriting a very special kind of product that you are really interested in, just reach out to them and say, hey, I see that you're an underwriter. Alyssa, you do musicians E&O, and I love music, and I love Taylor Swift, and I want to know everything about I can that that is involved with your job. Most of the time, people in the industry love catching up with students or early careers, and we'd be happy to tell you guys tips of how to get to wherever you want to get to. So with that plug, I will say, including risk management, which I love doing and I really enjoy. And just watching our time, I will not go through all the examples that I had hoped to, but I'll at least do one really good example. And again, reach out to me if you have questions. So in terms of what I do, what a risk manager does, I put together, I'll use this example talking about a specific type of risk. So I'll say, firstly, risk management departments usually are have different areas of risk that individuals on the team focus on. So not everyone is looking at every type of risk that we have in insurance, but we will oftentimes be focused on natural catastrophes. For example, one person may be focused on professional lines and credit risk, for example, and so forth. So just using this as an example, man-made risk example is, you guys might have seen a few years ago, there was a major condo collapse in Miami, the Champlain Towers condo, really devastating and really sad event. Part of the building collapsed, and that resulted in the loss of life and property damage. Some of the things and the factors that you read, and I'll say part of being a risk manager is being well-read and understanding different concepts of how things happen, or what a specific area is about. In this specific instance, as you read more, you understand that the building was was older. 40 years is not really old, but they hadn't gone through maintenance in a period of time. They were in the process of engaging with engineers. They had a report that had told them of all the key risks and all the issues that needed to be fixed. But for one reason or another, the fixing of things and the maintenance had been delayed. Part of it being that it was a condo that required each of the condo owners to pay a large amount of money to, to fix the issues in the building. And unfortunately, that hadn't been done in time, and it resulted in this collapse that occurred. Some of the insurance types that are involved were property insurance, casualty, errors and omissions. So Alyssa mentioned some of them: architects, engineers, individuals who might be involved in the structural aspect and how the building is made. Some, but not all. There's probably other lines of business that were impacted. But what I wanted to talk about was the box on the right, which is what might a risk manager do. So after the loss, part of my role sometimes in risk management is I'll get a question to say, hey, are we on this risk? Do we insure one building or another, or one major event or another? So part of what we'll do is we'll identify the exposure we have. We'll see, okay, what policies did we have for this particular event that occurred, and how much exposure did we have? That's one part of what we do. And then we will work with claims and understanding what the claims exposure might be, or what they expect we would have to pay, or processes and actions involved of how we can help our clients become whole. So that's right after an event happens. Before the next event, or also right after the event happens, we also start going into this mode of thinking, okay, how can we make sure that our clients are not affected by a similar event in the future, and we are not exposed to this type of risk? So mitigation actions we might take is maybe some different underwriting actions, Alyssa talked about how when she underwrites, she's asking clients about questions of what they do. In this example, if there's a major building collapse, maybe we'll start to ask different questions of the clients and say, hey, you guys are also in South Florida, and also, near the ocean and potentially exposed to similar risks as this was. What actions are you taking? When was your last engineering report? Who are you working with? Questions we might not have asked before, but now obviously they're relevant and things we want to know and think about. We will also think about monitoring this risk. So as I said, as a risk manager, we're looking at what we call a portfolio of risk. So not just individual names, but maybe we'll start to look at all of the condos that we insure in South Florida. And we'll say, okay, how can we reduce how much exposure risk we're going to have or help our clients reduce the exposure. So maybe we'll have our risk engineers helping them and supporting them in different ways. I've said set a risk framework. So we'll say, okay, our appetite is this much. So these are how much limits we want to have, or this is the action we want to take. So there's a very proactive nature there, as I've mentioned before, that before something happens, you want to know how we can reduce it. And then the last part is we will probably have some claims trends that we can use to see how often does this happen. You asked the question of how can we predict likelihood? Maybe we'll start to put some of those in practice and say, okay, we know this has happened, so now we can expect maybe another will happen. It's very important to pay attention to what regulators are going to expect of us if we're in that area, and also what the local government or federal government is doing about a specific action. Sometimes insurers are involved in any new legislation that comes out or decisions that are made about something. So that is my example here. I had two other examples, but I guess in the interest of time, we can skip them. One was on credit risk and the other one was on climate change. But I'll use this as an opportunity to say, please reach out to me on LinkedIn and ping me sometime.
Absolutely.
But I'll go to my last slide in 2 minutes, and then we'll take any remaining questions. The last slide I just wanted to highlight was the fact that as a risk manager in an insurance company, reinsurance company, we have lots of different types of risks that we might be exposed to. It's not just limited to insurance risk, which is what I focused on today. When I've talked, when Alyssa and I have talked about what she does as an underwriter and what I typically do as a risk manager, but we also have types of risks such as, I'll use 2 examples, reserving risk. So if we as an insurance company don't have enough reserves to pay for all the claims that we have from our clients, that's a type of risk, and that has to have some form of management and mitigation around it. And we do have every insurance company probably has a framework around that to make sure that we're always pretty close to matching our reserves to our claims. Reserves just means extra money that we have to make sure we cover the claims. There's also another big area that insurance companies or most companies will have is operational risk, which is the processes, the governance, the management of the company. So one example of maybe a poor operational risk is not having security at your door, and anyone can come in and out of your building, creating a risk if there's some kind of theft, if there's some kind of information theft, whatever the case may be. That's a type of operational risk, and there should be people who are looking at that and paying attention to, hey, how secure are our buildings? Who is coming in and out of our buildings, and do we know who they are? So you'd be surprised to know that every company actually does think about things down to that level. That is a type of risk that we have, beyond obviously the big picture is insurance risk and how much we're investing and so forth. But even just to how we operate and what things are happening on the ground is really important and could be a big risk for an organization. So with that, I will hand it back. Well, I'll say if there's any questions, please let us know, but I'll also hand it over to Ken. That's our presentation.
Fantastic. Love the presentation. While folks think about whether they have a question at the end, I jotted down a couple things that resonated with me. You kind of teased out AI and cyber. You talked about CAT claims. talked about aggregation of risk with the example that you gave recently. Got me hungry with the potato chip stuff and the risk management kind of cycle as well. I think Alyssa teased out kind of standalone solutions where maybe it's dictated by size versus blended deals, which was good to hear too. Content liability, kind of crazy plaintiffs and more. But really appreciate you both being here. I loved having both the risk management and underwriting perspective kind of shared together. A lot of excellent takeaways for folks. And as Rumbi and Alyssa mentioned, definitely reach out to the extent that you're interested in learning more in the chat with regard to LinkedIn and stuff. So going once, going twice before I tee up next week. Any last minute questions? Okay, so with that, for next week, kind of same bat time, same bat channel will be during the same hour block. Our representative for next week is Aon, and they're focused on commercial risk transfer. And in the event you have questions, please reach out, obviously, to the speakers, but to Megan, Tandeka, or I. Happy to answer questions that way as well. Thank you so much for being here. We appreciate it. Great job.
Thank you, everyone. Thanks, Ken.
Thanks everyone for joining.
Take care.